Okay, good evening, everyone. Sorry for the slight delay due to some technical issues. So, good evening, everyone, once again. Welcome to our tonight's webinar. My name is William. I'm your host for tonight. And before we start, here's a disclaimer as usual. For whatever we share tonight is for general information and educational purposes. It does not constitute to any recommendation to buy or sell any investment products. And about Phillip Capital, a brief background about our company. So our company is called Phillip Capital Sdn Berhad. We are incorporated in the year of 1995. Our company has been around for near to 30 years as of now, and we are wholly owned subsidiary of the Phillip Capital Holdings Sdn Berhad, which some of you may know we were formerly known as Phillip Futures. But as we grew and expanded our services and offerings, we have since renamed ourselves into Phillip Capital. Apart from that, we are a trading participant of Bursa Malaysia Derivative, a participating organization of Bursa Malaysia Securities Berhad and a holder of the Capital Market Services license. It means that we are legal and regulated broker in Malaysia. For your information, Phillip Capital has branches and office across Malaysia. Our mother company is from Singapore and Malaysia, but then for Malaysia, our headquarters is located in KL, Kuala Lumpur, and we have total of 11 branches across both East and West Malaysia. So if you are from any of the cities, you are most welcome to drop by our branches and inquire about our investment related services. And this shows the Bursa Excellent Awards that we have received over the past few years. And last year we were too honored to be awarded as the first runner-up for best retail derivative trading participant, as well as second runner-up for the best overall derivative trading participant. In Phillip Capital, we have a wide global coverage. As you can see, we have offices in 15 different countries as located here in the map. We are serving an international client base at different countries. And for futures trading, we provide products listed in global exchanges from the US, like the popular exchange, like the CME, the CBOT, and then this we call COMEX and NYMEX. We also have exchange from Europe, Japan, Hong Kong, Singapore, and surely Malaysia. With our global coverage, clients can trade both local and foreign products easily within one platform. So this is our products. Okay, now, so we are offering three main categories. The first one is futures trading, which includes different market across the index futures, like agricultural and then metal, energy, and interest rate futures. The next one is stock market, whereby you can trade Malaysia, US, Hong Kong, Singapore, and Australia share with us. And the third one is this we call CFD, which is contract for difference. We are offering local Bursa shares and also US shares CFD. And if you want to trade the US indexes itself, is like the Dow Jones, S&P 500, and also Nasdaq. We do offer it on a very competitive rate. So choose us as your broker, and you will like it. Phillip Capital is an award-winning broker. We are established and recognized in the market. We are offering 24 hours broking and execution support. If you have issues regarding your trades and account, you can call in our dealing desk and we have dealers ready to assist you. Besides, we have dealers provide advisory services on your how you would like to trade or how you can get started. Our team do also send out latest market news to our clients on a daily basis, so you can be sure to get the latest updates. And as mentioned earlier, our clients can trade wide different products on our platform. And lastly, we support online account opening, which can be convenient for you to start in a very short period of time. And apart from all those, we as well provide one-to-one coaching sessions. So if you're looking for a more personalized coaching on futures trading or example on how to use the platform, we can arrange appointments to guide you. Of course, we do frequently conduct seminars and webinars for free, like now, and you can also start trading by opening the account for free as well. And this is for the coaching session, is more tailored for beginners who want some guidance on the ideas of how to start trading on regarding the product's knowledge, platform, and charting system. So if you are interested, our staff are all ready and glad to assist you. At Phillip Capital, we consistently provide educational resources for investors. You can check out our upcoming seminars and webinar by scanning this QR code. or you may visit our website at www.philip.com.my to find out the schedule. We invite speakers from the industry as well to give market updates and insights. It is an excellent learning opportunity, so do not miss out on our events. On here, we have our weekly market call, so you can join our research team on the market views and updates for newly published report every Monday at 11 a.m. Or if you want to learn more on technical analysis like how to spot entry or exits for certain counters, this is for you. Our analysis will do the technical analysis on live counters every Monday night at 8 p.m. So for online account opening, yes, you can open your accounts for futures. Hold on, sorry. For futures, stock, and CFD with ease and convenience because you can just do it online in the comfort of your own place anytime, anywhere. So if you want to open an account, you may now take a screenshot or scan the QR code right here, and it will take you directly to the online application page. Now onto our trading platforms. The platform that we use for futures trading is called Philip Nova. It is simple and friendly to use. We have mobile app for iOS users as well as Android devices for those who like to trade on the go. Our platform is equipped with a wide range of technical indicators, live charts, market depth function, and you can get access to both local and foreign products. If you are not our current client, if you are not our client yet and want to try out our platform to see the interface, we also have a demo account for you to try out. Just scan the QR code here. You may take a screenshot. Okay, ready to move on. And for your information, our live charts are powered by TradingView, where, like I mentioned before, if before you can trade local and foreign products in one account, and we offer 17 global exchange like SGX, HKES, JPS, and we also offer 24 hours broking and execution support. You can sign up for a demo account to try it out. And this is for stocks trading. The platform that we use is called Points Global 2.0. For mobile, we have already have the version 3.0. Our platform offers all-in-one stock watch list, charting indicators, different exchange and their top 30 movers, and a very insightful stock analytics data. This platform is suitable for both new and experienced investors and traders. And this is the black platform that we use for CFD. It's called Philip CFD Trader. Our interface is user friendly as well, and it also has live chart, price alert, live market price, and different order types. And here comes the promotions. So for our current ongoing CME promotion, right now, if you open an account with us, you will get 100 ringgit touch and go. It's a very attractive welcome rewards. And of course, with the conditions that you must deposit a minimum of 5,000 ringgit into the trading account and opt to subscribe to our CME exchange. Each client is only available for one account opening hours. And this is our BMD futures campaign. Next, we have this BMD futures campaign called Trade and Triumph, whereby you have chance of winning up to 1,000 ringgit Malaysia. Plus, if you trade actively on the below products. You may scan here for more TNC info at this QR code. You may take a screenshot. Okay, ready to move on. And this is the last campaign here. It's called Trade US Index CFD at USD $2, where you can enjoy the best rates for trading gold and silver, crude oil, and US indices CFD with us at only $2 per contract. And lastly, before we dive into our topic tonight, allow me to introduce to you our speaker for tonight, Mr. David. For your information, Mr. David is a full-time proprietary trader with Iceberg S. Sandria Berhad, which is a local proprietary trading firm based in KL. Sorry. He does extensive research and is well-versed in the commodities and indices markets. He currently trades the Malaysia Index and crude palm oil futures market. Currently, he holds the designation as a chartered market technician. Previously, he led a young and dynamic team with a prominent local broker to promote futures and derivative instruments to the Malaysian public. He conducts regular public seminars and seminars on topics relating to futures trading and has aided individuals in starting their trading journey. In addition, he also provides frequent market commentaries to local media like The Star, Business Times, and The Edge. Now allow me to welcome Mr. David. Mr. David, are you ready?
Yep. Hi, William. Just a quick sound check. Can you hear me?
Okay, you may take over and share your slides.
Yeah.
Sounds
Okay.
good. Sounds good. It's very clear.
Yep. Okay. Yeah, you're able to see my slide as well, right, William?
Yes, in full screen mode already. Good to go.
Yeah.
Okay, pass to you,
Okay. Yep.
Mr. David.
Yep. Sure. Thank you. Yeah. So just thank you, Philip Capital and Bursa Malaysia for inviting me to speak on today's topic, entitled Technical Strategies and Market Outlook for CPO Market. So I think I probably have known that the market, especially the palm oil market, has actually been very volatile for the past couple of weeks. Ranging from 3008 to 4004. So indeed, I think volatility is great for traders. If you have been trying to navigate the market, you like this kind of volatility. Just that you make sure that you have to establish a proper risk management in place so that you don't get caught in the market. But having said that, I think it's good that we are now at the fourth quarter of the year. It's good to see where palm oil fundamentals are as we head into 2025, and where prices may directly lead us into 2025 as well. So as usual, I think just before I start, just like to put out a disclaimer. I think any opinion that is presented here is purely based on my own opinion. It doesn't reflect opinions, whether it's from Philip Capital or whether it's from the exchange itself. And I think if I'm not sure how many the audience here are new to futures market, but dealing with futures market does requires a lot of knowledge, and I believe you are in good hands. I think Philip Capital has a vast resources of informative uh, materials that you can use, and you can obviously talk to their licensed representative, and they can able to guide you, to open an account in the futures market. So I think materials that's presented here tonight is purely for educational purpose. So make sure you consult your licensed representative for your further action. Now, in the next half an hour to 45 minutes or so, I think what we're going to cover is these are a few key things. I think one to look at is when you look at palm oil, it's also good to look at the soybean oil as well. Now, if you have been trading palm oil, you do notice that this year Bursa has just launched the S-Soy contract, which is based on a Thailand soybean oil contract. So in other words, it's quite closely related, both markets, both are vegetable oil markets. So given that these two markets, they move quite parallel. So we have seen a lot of weakness in bean oil, and whether that will really translate to further weakness to the palm oil market in future is likely to be seen and yet to be seen. But I think it's worth to pay attention. If you have been trading CPO market, the fundamentals are developing quite dynamically. So I think it's important for us to be keep our toes on the fundamental cues that can really drive prices eventually. Now, I think the supply situation is quite unique. Later on, we just will look into the other slides. Today, we just have the official MPOB report for the month of September. Looks like production is quite sluggish. But having said that, I think 2024 this year production of CPO in Malaysia is actually quite strong. So the key thing is that in 2025 will it be a different story? Now, if you've been trading any commodities, be it palm oil or any other commodities, you know that supply and demand dynamics are very important for prices. So you have an oversupply situation, normally that will really bring down prices. So it's important for us to assess how supply and demand dynamics are going to play out in next year. Now, obviously, we are heading into the fourth quarter. Equities markets are also quite volatile given the fact that we have U.S. Federal Reserve aligning interest rates policies, which could affect in totality almost all market across the board. So in that sense, also I think palm oil, to a certain extent, is also feeling the impact. But it's indirect impact because I think U.S. interest rate doesn't affect directly to CPO prices, but indirect impact will be your ringgit, and obviously that will also be something that we have to watch out, given the strength of ringgit we have seen in recent days. Now, last but not least, I think it's important as a trader, if you want to navigate the market. Now, market now is trending. There is a clear trend. Market is actually, you saw the past 2 or 3 weeks is actually quite bullish. So it's a good time. When volatile market persists, when there's opportunity, it's good that you find tools, technical tools that can help you to gauge where the trend or market is going to head. And last but not least, in every trading plan, I really trade this in most of my seminar sessions or webinar sessions, is to make sure that with every trade plan, you must have a way to get you stop out, because in case the market go against you, it's always important to have the ability to come back to the market again. There's always trades that is in the market. If you don't have the ability to come back to the market without proper risk management, you probably find it very tough to be in this trading business. Now, I just want to give you a brief overview of where commodity is. I think firstly, you can really look at, not only palm oil this year in 2024 sustained a very good performance. I think the majority, the best performing commodity is the cocoa and coffee. So I think going to next year, be prepared to pay higher prices for your coffee, for a cup of coffee. Even you want to take a bar of chocolate, you'll be prepared to pay higher prices. I think these two commodities itself has almost rallied to almost double in the span of 6 to 8 months previously. Reason being simple: supply is affected by weather, and these coffee and cocoa markets are very small market, but the demand is great. So when you have a supply disruption like this, like weather, it can be a very big impact. We have seen that in palm oil as well. When weather is bad, or weather is too dry, it will affect production, and therefore it really push prices. So we are seeing that in cocoa and coffee. Now palm oil is not doing too bad as well. I think it's year to date is up almost 30%. And I think the recent rally also is trying to bring prices even higher. So let's see. I think whether can we end the year on year stronger compared to last year. Now, besides palm oil and even coffee and cocoa, I think generally commodities has actually been on the rise. Whether that is creating inflation, that's another story. But I think it's important to take note is that it's not only palm oil. You look at other commodities that we just mentioned, like cocoa and coffee, even sugar to a certain extent, they actually been trying to do a breakout. Again, these are all mainly caused by supply-driven dynamics. You have weather that is getting erratic. The one thing good about commodities, trading commodities, is the season. But one thing bad about commodities is that it's so driven by supply, which is again affected by weather, which is is unpredictable component. And therefore I think it make a job of, if you're analyzing the market, you make your job harder. But nevertheless, I think commodity prices in general is rising, and therefore I think palm oil is sitting nicely there to ride with the wave. Now, coming to fundamentals of palm oil, I think the first thing we always look at is the supply. So you can clearly see, I think 2024, we started off the year quite well. I would say last year, 2023, production was actually quite bad. Reason means because there is always an issue in the industry of lacking of labor, which actually caused impacted a lot of yield. And yield last year was not tremendous, not impressive. But 2024, we can see a big rebound coming in. But despite supplies coming in strongly, you can clearly see prices are still quite well sustained. So it goes to show, I think demand is also quite good this year. Now, the key thing is that if you just look at a pattern for production, this is since 2009 to 2024, that's almost 2 decades. You can clearly see a very nice pattern whereby, production tends to increase from February or March onwards, and it probably peak around August, September. We are now into September and October, which is the last quarter of the year, which is usually is the peak in CPO production. Now, what this tells you is this: if the pattern this year follows a seasonal pattern, it is quite safely to assume that production from now on, from October onwards to December or even January 2025, if you follow a seasonal pattern, it's going to stay low. Now, when supply is going into low season, what happens to your price? Normally, prices tend to be stronger. So I think do watch out. If you are thinking to try to short the market, you have to be aware that you are now entering a period in CPO production where production tend to decline on month-to-month basis. So do watch that. I think because of the seasonality factor in production is actually in fact helping to sustain prices above the 4,000 psychological mark. Now, if you just look at numbers alone, like I mentioned, 2024 is a good year for CPO in terms of production, because if you compare to last year, year-on-year change, I think each and every subsequent months this year, we are doing much better than last year. This is because I think the issue of labor is no longer a concern in industry. So therefore, I think there's a lot of pickup in production. But having said that, I think prices are still strong despite there's supply coming to the market. It tells you the market is still healthy, the demand is still healthy despite the rising production. Now, obviously, Malaysia is the second largest CPO producer. We used to be the first, but now Indonesia has overtaken us, and the production equivalent on an annual basis almost double of what Malaysia produce. Now, having said that, we are Indonesia and Malaysia accounts easily more than 50% of the total world palm oil production. Why it's surprising to say that Indonesia growth story in terms of production has actually pretty much ended. There's a lot of factors to it. I'm not going to go too detail in that. But what is having to say that medium term to longer term, we should be bullish on palm oil because if Indonesia is not producing much and Malaysia growth doesn't seem to show much of a production growth in years to come, it's going to be quite a tight supply situation for palm oil in general for the coming years. So I think that's if you're thinking to look at where the future of palm oil prices is, you just have to bang on a narrative that production is not going to increase in both Malaysia and Indonesia, and that's a good story to really support market going forward. Now, if you want to understand fundamental dynamics and prices, we can always look at stocks. If the stocks levels are too high, there's what is deemed as too high is any level that's between if Malaysia stocks hit above 2.5 million or even 3 million metric ton, that's a high stock to carry. And if you see those numbers, it usually tells you the market generally is going to be very weak. So what we have in this chart is that we have the darker color, the blue color, against the orange color, which is orange color is the price of CPO, and the darker color is actually your stock levels. So you can clearly see, I think stock levels right now below 2 million is just comfortably quite considered is quite low, and there's no sign of concern. But as long as stocks is not rising, CPO prices is well supported. Now, if we come to a situation where stock levels starts to rise, whether it's because demand is weak, supply is too abundant, so therefore stocks is rising, normally we will expect prices to be softer. So do watch out. There's always an inverse relationship between stock levels and prices. So as long as stock levels are not rising too fast or is comfortably sitting around the 2 million mark, CPO prices should be well supported going forward. Now, I just want to point this out because Indonesia has been quite surprising when it comes to, first of all, their figures are always 2 months late, so it's always hard to predict or to estimate where Indonesia production or stock levels is, and in fact the data is quite hard to gather. But nevertheless, what is interesting to watch out in Indonesia this year, and that mainly explain why CPO prices has actually been quite well supported above 3,005, or even right now you see above 4,000, is because Indonesia stocks is actually well below 2 million. That's a huge number. This is almost equivalent to what Malaysia stock is. Now, normally on average, Indonesia, which is the largest producer, they should have technically have higher stocks, and their stocks usually stands between 4.5 to 6 million tons. That's a lot. That's almost double what Malaysia average is. But surprisingly, this year has seen stock levels continuously on average below the 3 million mark. And in fact, I think recently, if you look at recent 2 months back data, it shows that Indonesia stocks are almost reaching or close to the 2 million mark. Now, this is quite crucial. It shows that Indonesia is actually very tight in terms of stocks. So going forward, if these are all positive signs, Indonesia stocks are tight, Malaysia stocks are tight, and if demands were to pick up, that will really push prices higher because eventually there's not much supply into the market as we are now entering into low seasonal period as well. Now, important thing about Indonesia dynamics when you talk about palm oil is always policies. Government policies are very crucial in Indonesia, and it's again something that you can't predict. Suddenly, over time, the government can just say, "Okay, I'm going to implement this policy," and prices will react. That's an element. If we trade palm oil, we have to bear with it, but important to take note as well because whatever Indonesia governments does say or implement, it definitely will have impact in the market. Now, on the export side, Malaysia exports this year also is quite strong, quite robust. Now, there's a couple of reasons. I think mainly is because you're now hearing stories like people saying China economy is slowing down. Now, technically, it does have an impact with China slow down. But I think much of the China's softness is actually overtaken by or overcome by India robust demand for palm oil. Now, if you look at seasonality, we are now heading to year end. Normally, the export of palm oil tend to slow down because year end, in the northern hemisphere like China, they demand less because of winter. And January when you go to festival period, they will usually buy 2 or 3 months before. Now, surprisingly, I think is one of the important element that we need to take note is that if you look at the countries breakdown is that EU, which is a very important buyer of Malaysia palm, has actually been buying a lot. There's a reason to it. If you have followed the news or the article recently, it has been mentioning that EU will probably implement the deforestation rule, which will impact Malaysia and Indonesia palm. But since then, I think just a couple of days back, they just came out. The EU Parliament just came out to to make a decision to delay that rule. So therefore, a lot of companies prior to this ruling, they have actually buy a lot. The EU companies are actually buying a lot to store up palm oil just in case this rule comes to effect in 1st January 2025. Now, since the rule is now being extended to or delayed to another year to the end of 2025, that gives us some space. But watch out, I think production is going lower. Usually fourth quarter exports is also going lower. So its key question is will stock starts to rise? If stock starts to rise, I think that will be something that will weigh down CPO prices. So watch out on stocks level as we approach the last quarter of the year. Now, I won't go too much on China and India, but the story remains. I think China is suffering on a its domestic economy is struggling. So therefore, I think that's affecting the demand for palm. India, on the other hand, seems to be the demand for India is actually very strong. Now, notice this: if you look at the statistics and numbers, India usually buys more around the June, August, September period, just before the Diwali season kicks in October or November period. So I think going forward, if you go into early November or December, once after Diwali festival is done, normally India will stop buying. Won't say stop, but they will buy less. So eventually exports will probably going into a down cycle coming to the fourth quarter. Again, always look at the stock levels. If stock levels are not rising, we should see CPO prices well supported. Now, I just want to highlight also, since we talk about vegetable oil, is it's important to highlight soybean oil, which is I would say it's like a brothers and sisters relationship. Whenever you see rising palm oil prices, you should see strong soybean oil prices as well. But this year is surprisingly is I would say is a bit of divergence in a sense that palm oil remains a very strong performer, but bean oil on the other hand has actually been an underperformer. You look at this red line, is the soybean oil prices against the black line, which is palm oil price. You can see there's a big gap here. So it goes to show, I think, really, if you're trading on or you're looking at assessing the market based on a soybean oil and palm oil spread. In fact, I think if you look at the discount or premium that they've been doing, normally there is always a premium market. Premium market meaning bean oil is trading more expensive than palm. But I think that has narrowed or even eroded. Right now, I think soybean oil is trading at a discount compared to palm. Um, so it goes to show, I think soybean oil. No, you must understand the soybean oil dynamics or soybean dynamics is an oversupply market. Why I say that is because America, US is second largest in terms of soybean producer in the world. They have a record production, and Brazil and Argentina, or rather Brazil, is number one producer in the world. They are also doing record planting. With these two countries doing all record, it's going to be abundant supply of soybean to the market. And China slowing down is definitely going to put a lot of pressure on soybean and soybean oil prices. So that's something for us to be mindful of. But then again, I think palm oil is riding on a different narrative. The fundamentals are different. Stocks in both Indonesia and Malaysia is actually currently quite low. So as if there's no sign that either country's stocks levels are rising, that should at least support palm oil prices in the near term. But bean oil is a different story. Bean oil is clearly an oversupply market with America and with Argentina and Brazil, planting massive record levels of soybean supply. It's going to be pressuring the market. So this is what I meant. If you look at it, this is basically the palm oil to bean oil spread. You have seen over the years, this spread has been to at least as high as 800 US dollar, which means that bean oil at one time traded 800 US dollar more expensive than palm. So at this point in time, if you look at this chart, this is the best time for you to be, shorting bean oil and buy palm, because at this point in time you can clearly see that, bean oil is clearly outperforming, and palm oil is clearly underperforming. But eventually, I think the spread has actually narrowed from 800 US dollar. Right now is doing at least negative about 20 to 30 US dollar. Now, discount markets, the thing about this spread is that, it tend to mean revert. So if you are a trader looking at, extremes, that's abnormalities or extremities, they tend to take position. But let me caution you. If you look at spreads, especially between both markets, that this is driven by different fundamentals, and the dynamics of it is different. The spread can stay premium or can stay discount uh, over a long period of time. So if you are thinking that eventually the spread will revert to its long-term average, but it will take time. So the question is, how long it does it take? Is really $1 million question. So, be very mindful. Despite you're seeing right now is a discount market, so there's a tendency for you to long bean oil and short palm. But you must understand the dynamics of bean oil and the dynamics of palm is actually very different at this juncture. So keep that in mind. If you are talking about mean reversion, is always a dangerous thing if both the market's fundamentals are very different. Now, this is looking at crude oil and CPO. So you can see the red color is your palm oil prices, and your black color line is your crude oil prices. Now, the story between crude oil and CPO is very clear. It's biofuel demand. So if you are thinking of you want to, if you are looking at higher CPO prices, normally crude oil prices will tend to be higher. Now, when you have high oil price environment, is there's more incentive for producers to go and blend palm oil with diesel, which is a very good feedstock mix. So in a way that, especially Indonesia, we imports a lot of oil, and they definitely don't like to import expensive oil. So as a result, when they have abundant CPO supply, what they do is that when they have a high oil price environment, they will definitely blend into biodiesel. Now the question is that when oil prices starts to collapse, or start to crash, that's where the demand for CPO will also start to crash, because there's no demand for biodiesel. So important distinction to take note. So right now, crude oil price is again very volatile because of the Middle East conflict. So really is to watch out if there's any spike in oil prices that will also bring a rally in the CPO market as well. So this is what I've seen. This is just, I think, in past couple of days, especially during the intense, or whether the Middle East conflict gets more intense, you can really see the spike in crude oil, and that quite will move quite synonymous with the CPO market as well. So if you are trading the palm oil market right now, it's also important to take a note of what happens in the crude oil market. Given the fact that right now is an important moment for the crude oil market because of the Middle East tension. So I think that's something for us to be aware of. You're trading the market. Now, talking about rates, what if you just look at this chart? The black line is a U.S. interest rate over the past 3 decades or 4 decades or so, against this red color line, which is your Thomson Commodity Index. Now, what this tells you is simple. I think what is very clear is that when you have an environment of interest rate starts coming down, which is what we are seeing right now in US, although that I think recent data is also pointing to you that US in the upcoming FOMC meetings, the interest rate path may not be so clear, despite what market is calling, or there should be more cuts into place. But again, it's all very data driven. If economists is not is going as well as they think, and there's no reason for them to cut further, rates in US can stay elevated for quite some time. Now, what is important is that when you have high interest rate environment, that journey tells you commodity prices tend to be strong as well, because generally economists is doing well, or and they try to tame inflation, so therefore they raise interest rates. But that's also signal that it's commodity demand. So it's crucial to watch. If rates in US continue to stay high, I think that could bring a bit of support for commodity prices. But again, I mentioned in the beginning of the webinar, interest rate effect is quite indirect, which is impacting the ringgit to US dollar performance. So if you have high interest rate in US, that means your US dollar is going to be stronger. So against the ringgit, so ringgit will get weaker. Now, if you look at the relationship over the past couple of years, whenever you look at ringgit and CPO prices, every time when there's a weakness in ringgit, normally you expect CPO prices to stay strong because if a lot of importers are transacting on US dollars, so right now when ringgit weakens, in fact they get more output. So in that sense, when you have a weaker ringgit, technically you should see higher demand for CPO and it will raise CPO prices. And vice versa, when ringgit starts to strengthen, that will really pressure the demand for CPO because now ringgit seems to be more expensive. Now, in recent times, we have seen the sharp position in ringgit, but that has not impacted much of the CPO demand. In fact, I think exports actually been quite strong. So really, I think can we base on this relationship to trade? I think we really can't because the prices of CPO it depends a lot on other dynamics that's in play. But again, I think it's a good relationship to look at over the long period of time. So if right now we've seen the recent days we've seen the weakness of ringgit, and I think that likely probably can be an additional support for CPO market in terms of prices. But don't try not to base on this relationship and make a trade decision because again, what happens in the past may not happen in the present or in the future. But I think it's a good relationship to understand between the ringgit and the CPO market and how uh, weaker or the stronger ringgit can impact the CPO prices. Now, when it comes to, this is looking at stocks and usage ratio. You can clearly see, I think palm oil right now is suffering from a low stock situation. It's a good thing, as long as demand is still strong. The key thing is that we just hope that the demand don't get too strong. If the demand gets too strong and we don't have enough supply, then you're going to eat into the stocks. And when stock starts to come down, then price will have to rally because that to adjust the supply and demand dynamics. So going to 2025, we have a situation whereby both the countries are on a low stocks level, which is a good thing that should support prices, CPO prices going forward into next year. Now, talking a bit of policies. Now, policies is something that we really cannot determine, but it's crucial to understand. So, like I mentioned earlier, EU has actually came out with this EUDR, EU deforestation rule that is supposed to implement comes 1st January 2025. But I think it's a last minute decision. Just a couple of months before the implementation date, the EU Parliament decided or EU Commission decided to delay by 12 months. So that create a lot of anxiety, especially among the EU importers. Therefore, you see Malaysia exports actually been quite strong the last couple of months. The key thing is that since now it's delayed a year, whether Malaysia exports, especially to the EU region, can continue to sustain or not. Because a lot of these countries, because of this ruling, ahead of this ruling, they actually bought a lot to try to do a stockpile. But I think now that the news that they're going to delay for another 12 months, so it's going to test whether the EU demand for Malaysia palm in the next couple of months is still going to be strong or not. Now, I just want to bring the topic on looking at futures forward curve. I'm not going to bore you with a lot of jargons, but I want. So what this forward curve basically tells you is that if you plot, if you look at Bursa Malaysia Exchange, if the CPO contract that has at least 12 to 15 months contracts ahead, so you're looking at prices 1 year or 1.5 years forward. Now, if you plot each of these contract on a monthly basis with their price individually, you can clearly see you can draw a curve. Now, this blue line or this blue curve was taken 7th of September last month. And this orange line is taken on the 8th of October, this couple of 2 days back. So you can clearly see that, the front month contracts, especially the November, December, January, February, has actually elevated quite substantially. Now, this happens normally when markets, especially when market supplies are getting dangerously very thin. So a lot of exporters or importers will push up because the demand in the frontline market has surged. It will actually push up the demand prices in the front month. So therefore, I think that explains why the market has actually been staying quite strongly above the 4,000 and it's been holding there. Now, why this is important is because once we get an understanding of this sentiment, then from there we are able to assess whether the market is bullish or bearish. So you can clearly see the market right now in the past couple of weeks. We have seen how the curve has changed. It clearly shows you that the market, in fact, the CPO market has in fact turned bullish because because of the strong demand, because there's also external factors like the sharp rally in the oil prices, and obviously the low stock situation in the country. So that's something for us to take home with. If you are trading the futures market, looking at the forward curve can sometimes give you a bit of a sentiment play on how the market sentiment behaves. So going on to the next part, which is important if you are trading the CPO market, like I mentioned, if you are trading it, whether it's full-time, part-time basis, it's important to have a plan. I'm a firm believer of trading a market with trends. So I'm a trend trader. So the first thing you always need to do is to identify the overall trend of the market. How we do that, there's a lot of ways. One is looking at the chart visually, or another way is to plot a moving averages. As long as the candles are above the moving averages, basically the market is on the uptrend. If the candles are below the moving averages, that shows you the market is on a downtrend. Identifying the trend of the market is important. That's the first step. And the reason why we do that is because if the market is trading on a bullish phase, and if you are trying to find entries for you to short, normally you get caught because the market is trending. It's not a good business to be in where you always try to pinpoint the reversal of the market, especially in a trending market. So importantly is that if the market is trending and if the market trend is bullish, always find position for you to long rather than short. Now, second thing is that if you want to find entries position or entry levels, we can always use what we call a Heiken-Ashi chart. So for those who are not familiar, Heiken-Ashi is just another derivation of your Japanese candlesticks. In fact, it's a middle bar for Japanese candles. Now, Heiken-Ashi, as I was shown on the later slides, is a much easier candle to use to identify trends in market. So the thirdly is to implement Heiken-Ashi together with exponential moving averages to give you a better entry and exit signals. Now, once we identify trend, it's also important for us to gauge the strength of the trend. Now, if the trend is lacking in momentum, lacking strength, is usually we use a technical gauge called DMI, directional moving index, to gauge the strength of the trend. So if the trend has actually from moving into a weaker phase, it's actually a good time for you to be out of the market. So DMI is a great tool for you to gauge the strength of the market, especially during a trending market. Now, last but not least, in every trading plan, like I always mention, we must have a plan to get yourself out. One way to do that is to measure your target profit and also your loss level. It's more important the loss level. So how we do that is to use a multiple of what we call average true range. As a way for us to calculate the level of risk that we're willing to risk, especially in a trending market. So right now, CPO is very interesting. If you look at it, we have been staying the sideways market for pretty much the last 4 to 5 months, hovering around the 4,100 mark to between the 3,700 mark. Just only off late, we have actually broke above the level. It is sustained well above the 4,000. So right now, we are really on a breakout point. Now, if you look at fundamental perspective, it makes sense because as we go into the last quarter of the year, normally that the seasonally production is going to be weaker, and as long as stocks are not rising, we should see higher prices. Now, keep in mind, one way to look at it, if you look at over the 1.5 to 2 years period, actually CPO market is still quite range. Although it has actually broke up a bit of a short-term range in recent times, but if you look at the longer-term basis, it's still pretty much a range market. Why I say that is because if you plot a 200 period EMA and a 50 period EMA, the candles are slightly on the breakup side, but it's still yet to see a real breakout eventually, unless the 50 period EMA starts moving higher. But having said that, I think short term wise, really we can see that the CPO market is still on a bullish phase for now. Now, if you just compare these two charts, if I show you chart A and chart B, it's the same period chart, it's the same product. The only difference is the candles. Now, if you are a trend trader, someone that looks at trends in the market, which chart will you be picking? Most of the people will say chart B. Now, chart A is a normal Japanese candlesticks, which is widely available. Now, chart B is what we call Heiken-Ashi candles. So the reason is because it's called Heiken-Ashi, is always talk about the average or middle candle bar. So why we use Heiken-Ashi is simple, because Heiken-Ashi keeps you in a trend longer. So in a sense that it helps you identify the trend at that point in time, and keeps you in the trend in the market at that point in time. So major difference, Heiken Ashi is actually very simple. There's only three major forms to take. Japan's candlesticks, there's 100 over combinations. It takes years to really master Japan's candlesticks. And if you look at candlesticks formation, most of Japan's candlesticks formations are very reversal in nature, while Heiken Ashi is very continuous, which means that it's more trend following. So in that sense, it's a major difference. Now, I just want to bring you back to these slides previously. I just want to highlight one important difference. If you look at chart A and chart B, despite the candles, the difference in candle colors, there's also one major difference is the gaps. So chart A, with your normal candlestick chart, they shows you the gap, while Heiken Ashi will cover the gap by the candle bar itself. So if you are doing gap analysis, you can't really use Heiken Ashi. You have to revert back to Heiken Ashi, candlesticks chart for you to do gap analysis. Now, three criteria in using Heiken Ashi. The first thing is uptrends, very simple. Like I mentioned, only three major forms. So as long as you see green body candle, and the body of the candles are getting larger, as long as there's no lower wicks, make sure uptrend, there's no lower wicks in the green candle, it shows you it's still an uptrend market. Unless only when the color changes, or when you start to see a green body candle but a double wick, that tells you the uptrend is losing momentum. So be careful. So as long as it's green body candles, the bodies are getting larger, there's momentum and there's strength in the uptrend. So if you're holding long position, you should continue to hold long position. Now downtrend is vice versa. You see red candles means it's downtrend, and if the bodies of the candles are getting wider or larger, that tells you the downtrend momentum is strong. And downtrend is a reverse. That means you shouldn't see any upper wicks in the red candle bar. If you start to see upper wicks in red candle bar, it tells you market is indecisive, or rather the downtrend momentum is starting to lose out. So if you're holding short position, that is a great time for you to be out of the market. Now the third way is always is sideways market. Now in sideways market or range market, you can't use Heiken Ashi or trend trading strategies, because you tend to get stop out easily. Now a way to identify when the market starts to trend is to look at the candles itself. So as long as the candles bodies are very small, almost like a doji, like in your normal Japanese candlestick, like a doji where there's no body but it's like a cross like that. That tells you the market is heading nowhere. There's no buying and selling momentum. The market is ranging. So suddenly, if you see an uptrend, then the candles, the green body candle starts to get smaller and smaller, and suddenly you see a cross. That tells you, generally the uptrend is losing momentum, and that usually be a good point in time for you to take profit or for you to be out of the market. So sideways criteria is simple. You start to see dodgy type of candles, and also could be in a series of green bars, you start to see red color bars with small body. Also, that tells you, the market is probably heading sideways, or rather the bullish uptrend is losing momentum. So sideways criteria are if you start to see series of green and red candles with small body, especially during a long uptrend or downtrend, is telling you, the market is going to head into nowhere. It's going to hit sideways only. So that's a good indication for you to be out of market if you are still holding position. Now, like mentioned earlier, part of it is also incorporating Heiken Ashi with using moving averages. There's two types. There's moving averages. There's many types. I think majority of people using is simple moving average, which is taking into account, or rather they give equal weights to all the information or all the periods involved. Now, exponential moving average is widely used, and is widely favored because if you look at when the market turns, when the candle starts to change color, the EMA lines will turn first, which tells you why is that so. It's because exponential gives more weight for the recent data as compared to historical data. So in a sense, EMA moves faster, or rather it envelopes the change in the trend much faster compared to a simple moving average. So as a result, a lot of people is they tend to favor EMA, using EMA rather than SMA, especially during a trendy market. Now, moving average crossovers are simple. So if you use two different periods of moving averages, one is usually a shorter term. In this example, I'm using a 9-period EMA, and another longer period will be using a 20-period EMA. If you cross that, so what it means by a bearish crossover is simple. That means the shorter term crossing below the longer term. and you start to see red Heiken Ashi candles, it's telling you the market is heading for a downtrend. Again, not only is telling you a crossover for moving averages, the main function of using moving average to get crossovers, is also the moving averages are also acting as a support and resistance level. Many times we've seen occasion like this where you start to see the breakout green candles and the bullish crossover on the moving averages, and as long as the candles are holding above the shorter term moving averages, is telling you the market is well supported. Only when there's a breakout or there's a break below that tells you no, the uptrend is gone. Okay, so I think not only is using moving average as a crossover, you can also use the moving average as also the support and resistance level. So this is what I meant. You can clearly see, as long as the candles are holding well above the moving averages line, is actually providing you a support level, or in other words, a resistance level. So not only the crossovers, EMAs also act as a support and resistance level for your Heiken Ashi charts. Now, I'm going to touch a bit on DMI. The reason DMI is used is for to gauge the strength of the trend. So there's three lines. I'm not going to bore you too much on the technicals. You can read it on the internet. You can Google it. The three lines are mainly comprises the positive directional indicator, the plus DMI, negative directional indicator, the minus DI, and last but not least, the ADX, which is the most important line, which measures the strength of the trend. So how we do this? So let's start off with just looking at two lines, the positive DI and then minus DI. So on the bottom panel here, this is what we call a DMI indicator. We have the green line, which is your positive DI. We have the red line, which is your minus DI. Now, if you start to see there's a crossover, or rather the positive DI holding above the minus DI is telling you the bullish momentum is strong. So clearly you can also see if you use a moving average crossover, it's a bullish crossover. So the signals of DMI using the positive DI and negative DI crossovers and using the moving average crossovers are very similar. So in a way, is there's a duplication of signals in certain ways. So this comes to a point whereby you can use moving average crossover strategy. You just use the DMI as a way to back it up, but DMI is actually mainly used for the ADX, which I'm going to show you on the next slide. Now, this is where, if you look at this black line, is what we call the ADX line on your DMI. This is a more important parameter to be looking at if you're using the DMI indicator. Now, what this black line shows you is simple. As long as you see rising, this black line rising, and if it's a downward momentum in prices, it's telling you this downward strength is gaining momentum. Means downward strength is having a force in play. Until when the black line starts to go flat, it's telling you this downtrend is starting to be, the momentum starts to wear off. So if you're holding short position, you should be careful not to really get out of position of your short position once you start to see the ADX line starts to go flat. Now, ADX, anything that is above 20 in value or 25 in absolute value, it shows you there's trend happening, or there's a trend in place, or there's the strength of the trend is there. Now, anything if ADX value is below 20 or 25, it's telling you the market there's no trend. It's a sideways market. So it's one good way to gauge whether the strength in the market persists or not. So a classic example is here. We can start to see, at this point in time, there's a bullish crossover on your moving averages. The ADX line is rising. When you start to see this kind of rising ADX, it tells you that this uptrend momentum, there's strength in it, and you should be able to ride it until whenever there is probably there's a peak in your ADX line. It tells you generally this could be a peak in the market. So that's how we use ADX to measure the strength of the trend. Now, if you put that into place, this is really what happened. How we compare. We have not only the positive DI and the minus DI line, we also have the ADX, which is very crucial if you're using a DMI indicator. It tells you, or it points to you when this uptrend market starts and is there strength to it. The most important key thing is that we must see the strength in it. There's no point if you start to see, there's a positive crossover, it's a good signal to turn long, but the ADX is not rising. It's telling you generally probably the bullish trend, it will not last. So that's the important point to take note. It's good to incorporate this DMI, especially the ADX value, in terms of your chart trading strategy. Now this was taken, I think, the chart before was taken on 20th September. The reason why it was a signal here is because you start to see there's a positive DI crossing above. Now this green Heiken Ashi body looks to be quite big. The next green body candles is the one that you watch out. So this poised for an upward move based on both the Heiken Ashi, the moving average crossover, and also the DMI indicator. And this was taken on 4th October. You can clearly see, there's clearly a breakout happening. So I think DMI tool paired with moving averages and Heiken Ashi is actually a great tool for you to really gauge where the trend or direction is and how strong is the trend of the market. Now, last but not least, in every trading plan, you must have a way to measure your risk level. And one of the ways to do it is what we use ATR value. Now, ATR stands for average true range. Is available on most charting platform. Is this all these charts are based on TradingView. So Philip, using TradingView platform is a good way for you to connect your charts on TradingView, and therefore you can look at it on a better basis. So ATR at this point in time, you look at that period is roughly about 22 points. Now, average true range measures the true range of the particular period. So when you have a high ATR value, that tells you generally the market is volatile. When you have low ATR value, that tells you the market is generally less volatile. So this is a signal for you to take a short. Reason means because you start to see bearish crossover, red candles appearing on Heiken Ashi, and you can clearly see minus DI is above the positive DI, and ADX, the black line, if you can see clearly, the black line is rising above 25. So it's a good signal for you to take a short position. So once the signals appear, the next thing that we really need to do is to measure what kind of risk and reward are we looking at based on the ATR value. So ATR at this point is about 22 points. So one of the ways you can do that is, let's say for example, you short a position at 39.22. Your ATR value is 22 points based on a 30 minutes time period. Your risk to reward ratio is, let's say, 1 to 2. That means for every one ATR risk or one ATR, you're willing to take a reward of 2 times of your ATR. So that means you're risking 22 points for 44 points of profit. So that's how you use ATR to measure your risk to reward ratio. Most important is your risk level. That's very key. Now, a lot of people, a lot of traders may have their own ways to get yourself or to manage your risk. Just stick with what works for you. But I think having as a start, having an ATR value is a good way to measure, because as long as the market gets more volatile, it means your ATR value is rising. You don't want to fix yourself with such a tight stop loss whenever the markets, if you have a too tight of a stop loss, you tend to get stopped out quite easily. So having a value based on ATR keeps you more flexible. But keep in mind, if ATR value is rising, it's telling you the market is getting more volatile. So in other words, that means your risk is getting higher. So you're preparing to lose more. So in a very volatile market, you have to prepare that your risk portion is going to get wider. And that's the nature of your risk and reward scenario. So this is what happened next. The red line is actually your exit loss level. Your black line is your entry level. And your green line is actually your reward, your profit target level. I think this is where we reach. Now, a lot of people can argue, say, hey, why not we hold this position until when the minus DI start to go below or positive DI starts to cross? Now, there's a lot of argument for it. That's again, it's all relates to how comfortable is the trader himself. If the trader is comfortable with having a plan, so be it. But like I always say this, I think in trading, it's all about sticking to your plan. If your plan is to get you out at this point, you should be out at this point. If the plan reaches target desired level, you should be taking your target desired level. Despite whether after you take your target level of profit, the market still runs ahead, it doesn't really matter, because then that will be looking at the next set of strategy that you'll be comfortable with. So there's always opportunity in the market, but the most important thing is that you have to measure your risk appropriately at every single time that you are entering the market. Now, obviously, at the end of every trading decisions or trading scenario, whether it's win or lose, as a trader, we always have to accustom or we make it a habit to always track our performance. And these are some of the parameters that we always look at: the win-loss ratio, the profit and loss for each trade, your equity curve, your volume traded, the worst thing that always a trader face is a drawdown, and a maximum drawdown, and it take the it can really break a trader. Once you suffer a massive drawdown that you can't recover, usually that ends the spell of a trader. So now these are the it's very much, if you look at how the dynamics of trading is in reality, it really depend much on how you measure your risk appropriately. So that's how you size up your risk and how you scale down your risk whenever markets are moving against you. So now, if you ask me for outlook, this is where the CPO market is. This is taken as of today. This is based on the daily frame. Now, really, you can see the positive DI in the DMI indicator is, and even the rate Heiken SG bars are starting to appear. Now, we are possibly looking at a temporary retracement in the CPO market. Now, if you ask me, I think the markets on the medium term, fundamental wise, is still quite bullish. Uh, Normal retracement in a bull trend market is normal. Whether the key question is, as we head into periods where fundamentals starts to shift to become more bearish, that's where you need to be careful. If the markets are at a different level, you really need to look at your charts. And one key thing is that you look at this bottom panel, which is your ATR, it's actually starting to rise. So the daily range for CPO market on average is about 80 to 100 points now. Those days is about 40 points. So really, if you are trading a market, volatile markets means there's more risk that you have to be prepared for. So measure that. I think is very important for us to measure our risk appropriately. And the dynamics of the market has changed. It's getting more volatile, and that's something that we have to be careful of as well. So conclusion, I think rising crude oil is an element that is very surprising, and definitely I think as long as there's geopolitical tension, that's still quite imminent, and that will probably be another factor that can actually support CPO prices in the near term. Now, if you look at it fundamentally speaking, fourth quarter usually is a strong period for CPO prices. Reason being is because we are entering to lower production period. Although exports are low, the key thing to always watch out is the stock levels. As long as stock levels are not rising, especially during the last quarter of the year, it's going to be something that's going to support prices. Now, demand we have seen so far this year is strong for Malaysia. Indonesia is less like so, because I think Indonesia really they're just focusing on doing their biodiesel mandates. So demand is something that we have to be a bit more concerned going to 2025. Having the reason why I say that is because we have cleared hopefully by then we have cleared the US election headwinds, and probably you get more clarity on where the future economy is going to hold in 2025. So I think demand is going to be very uncertain in 2025, but this year seems to be still a strong start, and I think the momentum is likely to be continued towards the fourth quarter as well. So I think demand is less concern for this year, but I think 2025 is something that we have to pay close attention to as well. Now, if you ask me for prices, I think it's very difficult to see anything that's below 4,000. But I think anything can happen. Market dynamics are still in force. Now, if you look at where the range support is for CPO market over the past 5 to 6 months, the 3,700 seems to be very hard to breach. Now, if you look at if you are in equities, you look at plantation companies, look where their cost is. Their costs are not getting cheaper year on year. They are getting more expensive. So as long as cost of producing or CPO is getting higher, it gives you a bit of comfort as to where the prices can go. Because normally, if prices go below the cost of production, there's no incentive for plantation companies to go and produce, because technically they're losing money. So I think that's a comfort that we can get. I think as we go, you want to understand the dynamics of the market. Costs is not coming down. It's going to be a factor that's going to drive prices higher. Last but not least is always, if the market is trending, trade with the trend, and it's always not against it. I'm just going to end with this quote. I always emphasize this is, when it comes to trading, it's all about risk. It's never about a profit. So I just want to quote from Paul Tudor Jones, a very great trader. So he always says, don't focus on making money, focus on protecting what you have, because the survivability of a trader always depends on the capital that they protect. It's never on the profit that they make. So with that, I'm just going to hand it over to William for any questions from the audience.
Okay, thank you, Mr. David, for a very wonderful and insightful sharing. So now, due to time concern, we will straight away move to our Q&A section. So for the audience, you may write in any question if there's still any. So far, we have received few questions already. So Mr. David, let us get started with the first question. There's Mr. Noding asking and Mr. Josh as well. They ask, what is the best ATR and DMI period? Do you have
Okay.
any response to that?
Yeah. Thank you for the question. That's a good question. Now, for ATR and DMI period, keep it to default, which is the 14 period, 14 period parameters. Now, I won't recommend to change the parameters for both of these indicator because if you change it again, if you do back test, you have a back test problem where you tend to curve fit the whole market. So I say just stick it to default. I think that's good enough.
Okay, thank you, Mr. David. So moving on to next question. There's Mr. Sharil asking, is Diwali is a sure indicator that FCPO price will go into uptrend? Is there any back test on this?
Okay, I won't say there's backtest for it, but if you look at seasonality, like over the past, let's say past 6 years, every year you notice around August, September, we nowadays it's hard to get the breakdown of each country, the export of Malaysia to each country. I think that the data is no longer made available for the public. But if you look at it over the years, the August, September period, especially from India, you start to see they'll start importing more around August, September period, just 1 month or 2 months before the Diwali. Now, whether that's a good indication as to where CPO market prices tend to rally, it could be, but I think importantly is that seasonality is just seasonality. There could be a time where India, because of certain reasons, they also have other oil seeds or vegetable oil. They may not necessarily need palm oil, as for example. So based on historical pattern, there is a tendency for India to usually buy, a month or 2 months before the Diwali season. So around August, September, usually you start to see a lot of India demand. But then again, these are all historical. There could be a time where this year could be different. They don't follow it. There's still a possibility. So I will say it's not a very reliable indicator, but I think because of the seasonal tendencies, we can, in a way, try to safely assume lah. But keep that hindsight, keep that in mind that things can change or that year can be different when it comes to demand from India.
Okay, thank you, Mr. David, and thank you, Mr. Sharil, for asking this question. And last, we have last question from Mr. Kuzaimi. He's asking, what time frame and fast, slow, exponential moving average the EMA setting is suitable that you are using?
Okay, thank you for the question. So, in most of the example I showed in a slide is using the 9 period and 20 period EMAs, and using on a 30-minute time frame. Now, I won't recommending you to use anything lower than 30 minutes. You can use 15 minutes, but if that day the market is not trending, is moving on a side range market, you tend to get a lot of false signals. So no, we don't want a situation where you get so many whipsaws. Ultimately, you get a lot of buy and sell signals. You're just you won't make much money, or rather you'll be losing money because of com. Now, I would say the best time frame to look at, to really look at, and to use an example is look at a 30 minutes time frame, and based on just using the 30-minute time frame is, I think, just sufficient, and using the 9 period and the 20 period as your moving average crossover. I think that's a good sufficient enough to look at the market.
Okay, I think that will be it. So thank you, Mr. David and Mr. Kuzaimi. Sorry, I lost my whole US. Okay, we have, hold on, Mr. David, if you allow, there's one last question by Mr. Nodin at this.
Sure.
His question is that, Mr. David, sorry, I lost myself when you were explaining about the biodiesel mandate by
Mm.
Indonesia. Would
Yeah.
this actually reduce demand for CPO?
Okay. Now, you see the I don't go too long story short lah. Long story short, when it comes to biodiesel, Indonesia is all about mandate. Now, when policies and mandates are different. It's two different things. Policies may not necessarily, the consumer or producer may not necessarily follow. But when you have a biodiesel mandate, like Indonesia that's doing now, that means the government mandate you as a producer to produce a certain level of biodiesel. So let's say now the mandate in Indonesia is B40, coming soon in 1st January 2025, uh, progressive implementation. That means if you are a producer, you have to use B40 biodiesel, means technically you're blending 40% of palm oil with diesel, and that will create a lot of demand for palm oil. Is biodiesel is a strong factor to push demand for palm oil and therefore prices higher. So I hope that answered the question. Biodiesel doesn't reduce the demand for palm oil. In fact, it actually, with higher mandate, it increases the demand for palm oil. Now, do take note. I think right now Indonesia is aggressively trying to do more biodiesel because the oil price is high, the government is budget is not looking good, so they have to use a lot of palm oil, and that caused a problem. That's why prices in Malaysia has been, this year has actually been, the average has been looking at about 3,007 to 4,000. Now, if the government decided to do a B50 next year, we never know. When that happens, I think on the back of calculation, easily they need at least 16 million tons of palm oil, and Malaysia 1 year produce 16 million. So technically speaking, if we are looking at B50 in Indonesia as a mandate, 1 year production in Malaysia is not enough to even do the B50 program. So I think that's gives you why biodiesel policies, mandates are so important, and that is an important element for CPO prices. I hope that answers the question.
Okay, Mr. David. So thank you for a very insightful response. So due to time concern, that will be the end of our Q&A session. Thank you again, Mr. David, for the informative sharing and everyone's being patient for it. So moving on to our online account opening. For audience who's interested in online account opening, you may now take a screenshot or scan the QR code right here, and it will take you directly to the online application page. Okay, moving on. And lastly, this is the branch's contact for you to reach out depending on where your location is. You can visit our branch or contact the branch nearest to you. You can also take a screenshot of this if you want, and if you have any enquiries, feel free to call us or drop us a message anytime and stay connected with us. For you guys who are keen to connect with us, you can find us on these platforms. Just search for Philip Capital Sendirian Berhad on our Facebook, YouTube, Telegram, and Instagram. We frequently keep you posted on the updates there regarding our events, promotions, market news, and updates. So be sure to follow us so you won't miss out on any of our updates. Now we to upload our recorded videos on our YouTube channels. Make sure you check them out. So once again, thank you. With that, we have come to the end of our webinar. We would like to say thank you and much appreciate everyone for your time. And thank you again to Mr. David for your sharing.
Yeah, thank
Once
you,
again,
everyone.
we
Thank you.
hope to see you. Good night.